Most day traders open their charts every morning with no idea which market is actually going to pay them today. So they trade what they always trade, force a setup that isn't there, and lose money on a market that was never moving for them in the first place. In this lesson, I'll show you the one filter I use every single day to know which market is the right market on the right day. And I'll show it to you live on a chart of the Japanese yen. By the end of this video, you'll know how to spot the exact moment a market reveals its real intent. When a daily high or low gets breached, traps the breakout traders, and then fails. That failure is the single most powerful day trading setup I've ever found. It works on yen, it works on gold, it works on any market with a chart. I'll show you how to confirm it, where to enter, where to put your stop, and exactly where the move is going. This is the setup my students wait for every single week. Stick with me. Let's get into the chart. Here is my favorite recipe. The market breaches previous daily low and immediately rejects. We have this up candle or series of up candles, which is what? It's our breaker. And we go through that breaker with what? A bullish fair value gap at 3 a.m., which is a very key time within the London session. Perfect entry right there. Because that is evidence that this has now turned around. We've taken liquidity on the downside, and we have triggered short sellers in the market who are positioning themselves to go short at the breakout of previous daily lows. We've trapped those traders down low and immediately reversed. The evidence of that reversal is many things. Number one, it's the fact that the market has gone through those up candles where I've drawn a box around which is our breaker. And if you don't know what a breaker is, there are plenty of examples on my YouTube channel. Just go into a search inside of my channel at Forex Recipes. Now, what's important is that we've gone through that breakout with a fair value gap. And ICT does have a name for that setup, but let's forget about the names. The fact is that we've taken liquidity, trapped traders low, immediately reversed, gone through the breaker with a bullish fair value gap, and now we are pushing down into that bullish fair value gap. Time is the most important element here. 3 a.m. is a very key time of London. That's the entry right there. These two down candles are also an order block that this down movement is coming into, which is the order block in itself. And we also have a balanced price range. If you don't know what a balanced price range is, do a search on my YouTube channel. There'll be plenty of examples. And if there is no example of a balanced price range, leave me a comment and I'll make a special video for you about that. And what do we do from that price point? We have an explosive move back up. Now, what's the target if we do enter here at 3 a.m. off of this bullish signal? Well, the target is going to be these equal highs on the left, which is also previous daily high on this day. And I've got a line marked there, and so we push higher. And what do we do in that push higher? We leave another bullish fair value gap. Now, notice that the market prior to the open of the New York session leaves this liquidity intact. What's that telling retail? That's telling retail that is resistance. And now we have multiple equal highs. We have that equal high there, and we have this set of equal highs, and that is essentially a triple top. Retail is thinking that is resistance, and they are going short right there, putting their stops above that zone. The real move is higher yet to come, and this move down is a pullback into this bullish signature, allowing the market makers to enter into long positions. And then we have an explosive move up, and what time is that? 7 a.m. That is the New York session. And we go up, and again we're leaving liquidity, and come back down. We go up, make another bullish fair value gap. And what time is that? 9 a.m. This is a 30-minute chart, so it's the 9 a.m. to 9:30 a.m. candle, which is the New York Stock Exchange market open. And then we get our move up that takes out all this liquidity, and the previous daily high above which resides buy stops from people who are short and haven't taken off their positions below this level, thinking we're going to continue going lower. And so you have multiple opportunities. You have an opportunity to go long in the London session at 3 a.m. Another one at the start of the New York session at 7 a.m. Another one at 9 a.m. 3 opportunities to enter or add to positions to go long. And each one of those levels should be targeting minimum previous daily high. Now what happens on this day? The setup is the same here. We had a breach of a daily low. Now we have a breach of a daily high. Now this bullish fair value gap is very powerful if you understand the reasoning behind why it's powerful. It's powerful because that bullish fair value gap has been formed as we are going through previous daily high. And if we now come back below that level, then that is a rejection of this high. And essentially that is the start of distribution. It's consolidation at the highs. Again, just like down here, we had breakout traders triggered into the market to go short. Here we've got breakout traders triggered into the market to go long above the previous daily high. These are my most powerful recipes when a daily level is breached and it becomes a false break. How do we know it's a false break? Well, you need to look for evidence. Just like I explained down here, we had evidence that it's a false break. By going above the breaker, forming new bullish signatures, multiple signatures at the key times. So we also have evidence that this is a false break once we come back inside the range. What do I mean by back inside the range? Well, coming back inside the range means we are back inside the daily range. Outside the daily range is when we are above the previous daily high. Now we can come back in for a pullback to go higher. But that is invalidated as a pullback when we start to invalidate the bullish signatures. For example, this bullish fair value gap that was formed on breaking the previous daily high. Once we go back down through there and close below and basically invalidate that bullish signature, then that is a reversal. And notice this candle pushing back up into that bullish fair value gap, which is now an inversion fair value gap. Now, that's your entry to go short. And there's multiple things I can see on this chart that you may not be aware of. For example, this move coming back up here, prior to this move down, what do we see on the left-hand side? See if you can notice before I draw it, these equal lows. You've got to look for these indications of where the market leaves a liquidity pool. If the market was really going to go higher, it should have taken out that low and then moved up. But the fact that it left those equal lows intact is evidence or a good indication that the market is building liquidity. How is that building liquidity? That is a double bottom beneath which retail traders are going to be putting their stops to protect positions that they enter to go long. But the key here is that this bullish fair value gap that was formed on the breach of the previous daily high has now been invalidated, and this candle is pushing back up into it, and that is an entry to go short based on an inversion fair value gap. And we have volume trapped up high for folks who are long on the breakout of the previous daily high. Now we also have what's known as a premium wick. This wick to the downside becomes a premium when the market goes below it, and pushing up into that wick is a premium array that we can also look to short or add positions to existing shorts. And so now we have multiple patterns or entries or signatures indicating that the market is headed lower. The fact that we have this breakout above a previous daily high and this bullish fair value gap has now been breached. We are pushing up into that bullish fair value gap and we are pushing up into the premium wick. These are all indications that this market is headed lower. But the key is that we have trapped volume up high, daily level breached, and immediate rejection. Now we're just looking for signatures to tell us when to enter. And what's going to be our target? It's going to be where this pump started, which on this chart is going to be the previous daily low at a minimum. And this continued lower to the previous weekly low. So, I hope you've learned how I read the charts. Go back, rewind the video, and study this chart. This is Thursday, the 16th of April, 2026, and Friday, the 17th of April, 2026. Looking at the Japanese yen, one last thing before you go. We have covered many concepts in this lesson. False breaks, breakers, fair value gaps, order blocks, balanced price ranges, inversion fair value gaps, premium wicks, and trapped liquidity. My coaching is where these concepts become consistent income. 12 months, group coaching, cohort-based, live trade reviews with me directly. And it's the only place I work closely with traders. We're filling the current cohort right now, and there are still a few seats left. If you've blown a few accounts, you've put in the years, and you're still not consistently profitable, apply at forexrecipes.com. I read every application myself. If we're a fit, you're in. If we're not, you'll get honest feedback and your deposit back. I look forward to talking with you in the next lesson.